It's time for the market update.
As far as the market is concerned, we are seeing interest rates staying higher for longer. And that's actually the language that the Fed has used to describe their Fed stance, their stance on the federal funds rate. And I think this comes out of the job market has not softened, and inflation, although it's come down in a lot of places, still remains stubborn in certain segments. So they've positioned themselves to say, data dependent, we might raise again by the end of the year, but there's also a good chance we don't raise, but we stay higher for longer. And 30-year fixed rate mortgages, due to that stance and statement in the past week, have increased again. So we're, getting closer to, 7.5% on a 30-year fixed.
And I know many economists thought it would be coming down at this point, right? I mean, that was projected. And it seems like we're having a lot of the similar conversations over the last few months, right? It's just kind of holding steady. Yeah, we expect things to come down. We'll kind of keep an eye on it next month. But I don't know that we're necessarily behind where we thought we'd be, but I think maybe some people thought we'd be a little bit lower at this point, right?
I think people thought we would be lower than where we are at this point. Now, if you look at some of the core inflation numbers, they're definitely coming down. There's no question about it. But 30-year fixed rate mortgages often lag behind. So there's sometimes a 6 to 12 month lag. If you look at a chart, I was looking at one the other day that tracked 30-year fixed rate mortgages and inflation came down, and then behind it, lagging, was the 30-year fixed rate mortgage rate. So we might be 6 to 12 months behind that. And that's why when we're talking with customers, we're saying, be prepared to have this payment for 12 to 24 months. If you can hack it, rates are going to come down, but you're going to have to wait out this period of higher rates.
I know nobody wants to really hear that, but it's the reality of it right now. And I know there's a lot of people that are ready to buy and looking to get into the market now. Of course, we've seen inventory low, as you mentioned. So what effect has this had on the market right now? So
that's a great question. The effect it's had on the market is, from a first-time home buyer perspective, when they're making their comparisons, they're comparing against rent. And rents are very high right now. So for them, they still feel like buying a home rather than continuing to pay an inflated rent amount because rents were hit severely by inflation, it still makes a lot of sense for them. So we're dealing with a lot of first-time home buyers. We're also dealing with people that are in that I have to do something. There's enough reasons and they're checking enough boxes in the categories of I need to do something. Whether that's divorce, which pushes people to do things, or even less severe measures. What we're finding is the I want an extra bedroom or a larger kitchen, and it's more of just it's not a need, it's purely a want. Those folks are the ones that are sitting on the sideline. Now, the beauty is those folks have a lot of equity, so when they sell, they're going to roll that equity into the new purchase. The problem is they're going to give most of it back, and then a lot of them are going to go from a 3.5% rate to a 7% rate, so they're going to double their rate. So what we feel like is, and there's a lot of studies to suggest, is doubling your rate doesn't feel so good, and those people who just want to do things are just going to stay put for a bit. But for the individual that is going up 1.5% in interest rate, maybe 2%, they'll make the move. They'll forego their 3.5% rate for 5.5%, 6%, because that makes sense to them mathematically and within their budget.
It's a tough position for a lot of people. And, even if you are in that spot where you got to move and, you have to kind of give up all that equity you've earned, I mean, you could be in a worse position, right? I mean, the good thing is that you've been building up that equity the last couple of years, so it does give you a little bit more flexibility. And then hopefully over the next year, we might see these rates come down again. And then, of course, as we talk about the refinance options on the table for anyone that gets into a house now. So a lot of things to kind of keep an eye on. What's most important to you these last couple of months here before we close out the year, Bill?
Yeah, what's really important to us, especially in this environment, is You're always combating the news headlines. And your good media outlets, I mean, there's truth to what they're saying, but there's two sides to the coin. And here's an example of that. So right now, if you're straddling that line between wants and needs, okay, and you've got a lot of needs, but you also have some wants, and it's just not clear cut. Those are, a lot of people are in that situation. So what we like to do is kind of break down the math. And one of the things that we look at is a cost of waiting. What does it cost to wait? Because if you're just waiting out the market purely to see more inventory and lower rates, and certain news outlets have the market, values crashing, we don't think that's going to happen. Because even beyond this current moment in time with high rates, when rates come down, there's going to be more inventory, but we're still going to have an inventory shortage because builders did not build for 10 years after the Great Recession. We're going to have a long period of time of low inventory. So when you look at the cost of waiting, what that means is if I wait a year and rates are lower, what am I really saving? So we put that into an analysis, and what you'll see is it helps people to understand that even if they buy now with a higher interest rate, as opposed to waiting for lower rates, values are probably going to continue rising, and there's a cost to that. And nobody can guarantee an outcome, okay? Nobody can absolutely guarantee that the way that we lay it out is absolutely what's going to happen. Hey, if I could do that, Ben, I'd be, we'd be very wealthy, right?
Yeah,
but
exactly.
The point being is this is a very likely outcome, and it's something to consider in your analysis. So when you're talking with us, if you ask us to work up a cost of waiting, and we actually have a video that we send out on it, it's very informative because it levels the playing field with what the media is saying about high rates, high values, and low inventory.
Is that part of the initial consultation? Is that something you can run for someone that is meeting with you for the first time and saying, hey, we're thinking about it, but what is that cost of waiting? What could that look like in a year from now?
Yeah, so what happens, Ben, is on the third step where we present your pre-approval and your loan estimate and go over all the details, that's actually where we would present the cost of waiting. And it opens a lot of eyes. It's something that we found to be very helpful with people making decisions.
You got to weigh everything, right, in the process and figure out what's best for you. And if you want to begin those conversations, talk about your mortgage options, talk about rates, all those different things, the best place to start is by giving Bill a call, 484-352-4151. You can also log on, smartmortgageshow.com. You'll find all of our videos. You'll find podcasts. You'll find a way to get in touch with Bill, plus some resources, some guides there to help you as well. But again, take advantage of that free 15-minute mortgage and loan consultation. Bill is the regional president of Cross Country Mortgage, and we'll be happy to sit down with you and walk you through that process. But Bill, we thank you for the update here in October. I know we are all anxiously awaiting a little bit more positive news moving forward. Hopefully November and maybe the holidays will bring that for us, but we'll stay tuned.